spouse, significant other, kids, whoever the beneficiaries are, have some kind of plan and framework so that it's not just like a bucket of money.
Yeah.
If you just leave behind a bucket of money, it'll get spent and burned through faster than you could blink. You will be rolling in your grave on how fast that happens. It is really, really sad to watch.
Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Happy New Year, everyone. Got Carisa in the studio here with me today once again. And today we are just talking briefly about some of the things that you should be doing or considering doing as we start the new year and what you can do to just kind of start it on the right foot. So a couple quick points where we talk briefly about building your net worth statement, checking your 401k or retirement, asset allocation, looking at your beneficiaries, some estate planning, some insurance considerations, just how do you button it all up going into the new year? Enjoy the show. Okay, we're talking today about just financial objectives for the new year.
Yeah, like some resolutions, because I feel like this is going to be coming out at the new year, right? So
okay.
Everybody's going to want to talk about, setting new goals, resolutions, how do I be better? And so just wanted to talk through some of the things that people should be looking at and maybe some of the things that they should consider as they're moving into the new year.
Yeah, I like that. I think there's some key data points that people should take a bearing check of going into the new year and see what minor adjustments they can make to help increase their chances of success. I mean, that's really, to me, like that's what... that's the difference, in my opinion, between wealth management and financial planning. Is financial planning, you get a ream of paper, that somebody prints off for you and they say, here's your financial plan, do all this, make all these changes, and then you're good. And the problem is it's more of like a one-time thing. Now, CFPs will probably disagree with that because they added a couple of years ago, like the last step of financial planning is to monitor and readjust.
Yeah.
However, I think people tend to think of financial planning as like, okay, I did a plan and then, okay, I'll readjust in a couple of years and, and then I'll do another plan. And for some people that works really well. So nothing against that, but I believe more in a wealth management model where you're kind of constantly doing these bearing checks, getting stuff organized, keeping it updated, and making adjustments as you go. So more of that kind of constant fine tuning more than, big changes on reams of paper. So that being said, what is the first thing that you would do heading into the new year to just organize out your thoughts and give yourself some kind of baseline to start getting clarity?
I think something that's important is to go through and review your net worth statement. Make sure that that's updated so you understand, all your assets, all your liabilities, where you're at.
Yeah.
In the current year and going into the new year. I think that gives you a lot of valuable information to start with that. And again, going back to what you're saying, of like doing this throughout the year, I think it's an important thing to do throughout the year. I don't think you should wait until the beginning of the year every year to look at your balance statement.
Yeah.
That should be something you're doing on a regular basis. But I do think that it's a great place to start, like in the new year, getting everything set out, figuring out where you're at, how much do you owe, how much do you have in assets, where are your assets?
Yeah. If you haven't ever done one before, all it is it's a personal balance sheet. It's all the stuff that you owe and all the stuff that you own.
Yes.
Right. So if you own a home, you likely have two line items associated with that. So the first one would be the actual home and the value of the home. And then somewhere on that paper, you're going to put the mortgage, which would be a negative balance because you owe it. And the difference between those two numbers is reflected down at the bottom of your balance sheet. And that's what we would call equity or net worth. For somebody that hasn't ever done that before, it might take you a little bit of time because you got to look up a lot of accounts. You got to remember everything you got. You might have to hop on Zillow and see what, Zillow estimate says your home's worth.
Yeah.
You might have to get logged into your 401k that you don't normally log into. And these kind of little headaches. The more that you do it though, and the more that it stays up to date, the quicker it is. So I know like when we do them for people, man, it probably takes me for one of our clients, maybe 5 or 10 minutes to update their net worth statement, for the most part. So it goes pretty quick once you have it done, but the first time might take a little bit longer, but worth it. That number at the bottom will hit you in the face for better or for worse. I have seen it go both ways, right? People are like, oh my gosh, I didn't realize it was that bad, or kind of sad. Or wow, I didn't realize I was doing this good. I'm doing better than I thought, it's like, and that's encouraging. Hey, and what I'll caution you is let that be an encouragement to you.
Yes. Don't
let it be a behavioral hindrance where you just say, oh, well, I think maybe I'm ahead now, so I'll take my foot off the brake, because, things go up and things go down, and you never know what's going to happen. So, don't get over your skis there.
Another reason that I love the net worth statements is that, and looking at that at the beginning of the year too, is you can look back and see your progress, and you can see where that progress was made, or if, you've gotten off track, and maybe added in some debts or, some different things that, it just helps you kind of realign with your values and make sure that you are progressing on your overall goals.
Yeah. I think it's kind of the master statement, right? If that statement's not moving in the right direction, none of your goals likely are moving in the right direction. I say likely because nothing's absolute. So
you never know for sure.
Well, I mean, we have clients that their goal is to give more money away, so in that regard, maybe it is right. However, you would only know that. It still tells you if you're on track for your goals, right? Yeah. So you want to make sure that the direction of your balance sheet movement is in alignment with what your goal expectations are.
Yes. The next thing I think that's important is to review your portfolio. So now that you have your net worth statement, your balance sheet, whatever you want to call it, you know what all accounts you have, right? You know what's part of your portfolio, but then diving in a little bit deeper and understanding your allocations and the diversifications. And I think that this would be something that I want to ask you of, what do you think would be the most important things for someone to look at as they're reviewing their portfolio?
This one's tough because everyone's individual, everyone's an individual. So, I'm very tempted to give my opinion and thoughts about what people should have in their porthios and what I think is going to go well.
Important things to be aware of.
Yeah. So, some things to be aware of. Let's start with 401k assets, because that is where most people have some assets.
Yeah.
And they don't have a lot of options and selections to make, right? They have a limited menu of options, if you will.
Yeah.
And because of that, it's kind of sometimes the toughest. It is the easiest and toughest thing to manage.
Yeah.
It's easy because you have a limited number of options. And so you just pick from one of them and you put it on autopilot, right? And from that stance, it's easy. If you know a little bit more what you're doing, it gets really frustrating, right? Yes. So I would say some things to understand is what is your, what's your general asset allocation in that? So what do you own as far as stocks relative to bonds, relative to alternative investments? So that would be like if you own, 60% stocks and 30% bonds and 10% alternatives. And alternatives could be a lot of different things. And a lot of 401ks don't have alternatives available in them. So that one's tough. And I'm not saying that's the allocation people should have. That's just an example, just like that's what it would maybe sound like, right? Digging in deeper, I would say understand what you own a little bit more under the hood and why you own that. I think one of the common things that I see in 401ks that people own is a lot of international developed markets and emerging markets, and then core bond funds. So let me start with the first one on international. And this is where I say, know what you own and why you own it. My thesis, like in our firm, like our clients will not find really international investments in their portfolios very often. If it is, it's a very targeted investment. And typically for a short time, it's really more of a trade than an investment. Mm-hmm. And the reason why is just structurally at this point, like developed markets do not keep up with the US, right? Mm-hmm. And so they have underperformed for well over a decade now. And yet they carry the same, if not more risk, I would say more risk than investing in the US. So you get less return, more risk. Mm-hmm. And there's argument out there. There's kind of counter perspective that say, well, in the early 2000s, they did well. And that's where all your return would have come from, was having those international exposures. And while that is a true, hindsight fact, right? Remember, investing is not a hindsight game. It's a forward-looking game. Yeah. Right? All you can do is look at...
help you if you weren't in it at that time period.
Well, right? And just to say that it has happened doesn't mean it will happen, right? Yes. So correlations are not stable, and any good portfolio manager understands that. That being said, if you kind of look forward and say, well, what are the risks I take internationally? Mm-hmm. Well, I take on currency risk, which is quite big. And they have what's called the dollar hegemony, right? There's kind of no alternative to the US dollar. We're a reserve currency of the world. So now I'm betting against that. Mm-hmm. The US economy grows fastest growing economy in developed markets. For comparison, right? When we talk about when did this fundamentally change? Well, this fundamentally changed kind of after 2008. And when we went into 2008 in the great financial crisis, the US economy and the European economy were basically the same size. Mm-hmm. And since that time, the European economy has grown, but the US has grown at such a faster rate, it is now double the size of the European economy.
Just since 2008.
Yeah. And so, your investments, when you're buying, broad market investments, right, like index funds or whatever it might be, it's a derivative sort of the economy, right? So economy grows, stock market grows, right? Is kind of the correlation there. So what you would have to see is Europe, for developed markets, Europe and China, depending on kind of what your view is on developed markets, change and start outpacing the US. And I don't think either of them are really interested in that. I think Europe has too much regulation. Mm-hmm. And China has obviously a plethora of other issues. Most importantly, though, for us and our clients is that I look at it and just say the trend is clear and defined that the U.S. is going to outperform, or is likely going to continue outperforming, right? And it just outperforms, for so long on a relative basis. Now, I tell people, if the trend changes, right? Mm-hmm. I don't need Europe to change regulation. I don't need China to change regulation. I don't need any of those things. What I need is I need it to show up in the price. So if the price of international markets shows up different and it starts trending and beating US, then we will change our allocation perspective, right? Yeah. But we are going to let the price change us, because you can't buy things on valuation. Yeah. And you can't buy things on forward earnings. You can only buy stuff with price. Yep. So, and what I mean by that is there's no more important thing to your 401k than what the account balance is, right? Same with your IRA. So understand what it is, why you own it. Why do you own emerging markets? And if it's because you just selected, I'm risky. Mm-hmm. Well, you may want to ask yourself, can I get something that's going to at least give me some kind of additional return for the risk I'm taking on here?
Yeah. What's that risk return profile?
Yeah. And so, you might be riskier, but that doesn't mean you're going to get a better return. Yeah. By any means.
And I think that's something that a lot of people miss right there.
I would say the next thing to understand is your bond side of your portfolio. Mm-hmm. What kind of bonds do you own? Why do you own them? And what's the risk exposure you have there? Because people will say bonds are safe. Bonds are not safe.
We got to see that a little bit in 2022. I think some people
don't realize 2022 was like a 2008 for the bond market, and it still has not recovered. Bonds are just different than stocks. They're not safer. And so what I mean by that is there is a built-in yield, right? And so that's why people think it's safer, because a bond is a debt somebody has to pay you. But now you're talking about bond funds. And so that may or may not play out, what you're hoping. But if you get 3% a year on yield, but you lose 20%. How many years do you have to break even? And so now, is that a safe trade or is that kind of risky?
Yeah.
And so you got to be able to evaluate your risk there. Now, if all else fails and you have no other alternative, you do not know what to do, you can go with what they call a target date fund. Not my favorite, but it is something that should glide path you along over time. I think there's some fundamental challenges with target date funds. But if you really don't, right? Like if you're going to say like, well, I don't know if I should go all stocks or all bonds. I just really have no idea. Like look for something that just seems more prudent.
Yeah.
You know, just maybe avoid drastic changes, right? So, you know, okay, maybe not all aggressive or all conservative. Somewhere in the middle, right? Target date fund is again, not my favorite thing. But it's an option. It's an option to consider. And if you are somebody that has the means to, you know, pay for a little bit of advice, you know, you can reach out to us. You can reach out, you know, there's different financial planners out there, investment advisors that will, you know, you can pay them for advice on what you should do and how you should allocate your 401k.
Yeah.
That being said, I think like it gets way more complex than that. I think if we get into IRAs and now you have all kinds of stuff. What I'll say is, if you don't know what you're doing with your asset allocation, get some professional help.
Yeah.
Like if you don't know what the word duration risk means when it comes to bonds, it like get some help, you know, start doing some research, ask some good questions. And, you know, just, there's a lot there. There's a lot there.
Okay. We could unpack that for a long time.
But it's truthfully, you know, and here's the thing, if you're somebody that wants to learn, it's something that's so a mystery that it's not solvable, right?
The information's out there, right?
The information is out there.
Whether you're willing to take the time and effort to go through it.
Yeah. If we ever say words on this podcast that you're like, I just don't know what that means, send us a message.
Yeah.
I will personally try to send you back a message with a definition, an example, and understanding, and happy to try to explain something to you.
Yeah.
Okay. So net worth statement, check your allocations, just make sure they're not wonky.
Yep. Reviewing that portfolio, making sure it hasn't gotten like crazy out of balance. You know, if something has really performed really well and something's performed really poorly, just kind of making sure that rebalance is happening. You know, if it's not doing it automatically within your portfolio, you know, within your 401k.
Yeah. And make sure it's invested. Like it's not like people will bring us a statement and, say like, well, I have a Roth IRA or I have this 401k and it's like in cash. It's like, yeah, you have the account.
Yeah, that's the worst.
It's in cash. So, if you strategically for whatever decision you want it to be in cash, that's one thing. But, if your expectation is it's invested and growing, I would say, you know, be mindful of that.
Yeah. Make sure you know what you're in and that you are invested.
Know what you own and why you own it.
Mm-hmm. And then the next part I think that is important is to simplify and consolidate. So, you know, if you've made changes throughout the year, if you've gotten a new job or if you've, you know, opened an IRA or you have an old 401k or something like that, consolidating those, making sure that you know where your money is, what it's doing, you know, doing a rollover if needed, whatever that is, you know, that you need to do. But just making sure you don't have money out in all these random places that you're going to forget about over the years.
They're supposed to be making a database of like where you can search if you have a old 401k assets or retirement plan assets and see where they're at and, you know, figure out how to go collect on those.
I know there's like some different websites that say they do that, but you have to pay and put in your social and I don't trust them. So.
Yeah. If you think you have an old retirement account somewhere, like call the employer you worked for and just say, hey, I used to work there. I think I have a retirement account. Where's the 401k plan?
These are the years that I worked here.
And well, when they move a 401k plan, they either have to send you a distribution, so they have to send you the money. If they can't get a hold of you, then it's going to be likely at like the unclaimed state property. Like I know in Utah, there's like a website you can go to for unclaimed property and search there, you know, and you'll likely be able to recover it that way. But more times than not, they just keep it, if they keep it in the 401k, even if they move the plan, it's now in wherever the 401k plan is currently at. Yeah. So you can just say like, hey, where's the plan currently at? Oh, it's still at, you know, Fidelity or whatever. You can just, okay. Like if they are stop being helpful beyond that, they just call it Fidelity and say, look, I think I have an account in an old 401k. If I give you guys some of my information, can you search for it? And they'll do it.
Yeah,
so
it's really
that's one
not
way to find it.
difficult. It just takes just a little bit of time, but it is worth it.
Yeah, but all else considered, it's money you already have, and it's easier to, keep track of money you have than to make new money.
Yeah.
So
for sure.
What about just setting up, making sure that you have your contributions all set up?
I think that one's super important. So I'll just give you an example, a story that happened to me and my husband. So I normally take care of all of the money stuff, right? My husband's like, you're a financial advisor. You know what you're doing here. Just take care of it. But when it comes to his workplace stuff, I can't just go in and take care of things. That's something he has to do, right? So his last employer, I was under the impression that he was making contributions, automatic contributions, salary deferral. And he thought he was too. He wasn't. Because he forgot to set it up. So he saw that his balance was going up, but it was because the employer was making the employer contributions, but he was never making his. So he missed out on a lot of opportunity just because he didn't double check. And I guess I didn't follow through on that. So I think that's one, just really simple thing that you can do is make sure that you have those contributions set up. Know how much you are contributing, maybe increase that contribution as you're going into the new year. But set it up so that it is automatic so you don't have to think about that and that it's just coming out.
Yeah, I always think one of the ways that people could become the easiest way to make the biggest difference is when you get a bonus, just invest it or
half of it.
Well, use some of it towards working towards a goal, not just, my goal is to buy a Corvette and I got this bonus. So I'm going to go buy the Corvette now. Right. But I mean, a really meaningful and impactful goal to your family. Look, if it is a Corvette, that's your goal. It's personal to you. But I always think in terms of, invest, save and invest more money. Cause I am trying to buy back time in the future when I invest. Have some important legacy goals that I have. So, but if you get a raise, it's $1 an hour, just increase your savings rate. Try not to, increase your lifestyle $1 an hour, right? Increase your savings rate $1 an hour. That can make a huge difference for people.
It really can.
Right.
It gives you so many other opportunities in the future that $1 an hour now really just doesn't do that much.
Yeah.
If you're spending it.
Yeah. If you get a New Year's raise, consider calculating what that's going to be on your, paycheck and just increase your 401k contributions if you can, Yeah. It'll make the best part is it doesn't feel like you did it. It's nothing changed. And then all of a sudden, a year or two later, you're like, whoa.
Yeah. I've even seen there's a lot of companies that will let you do a 1%. It just automatically bumps up your contribution 1% every year. And people don't notice 1% difference from their paycheck, really.
They don't notice it on their paycheck, but if you go do a net worth statement update every year, you'll notice it there.
You will see it there. Yeah. It makes a difference. And so it's just those little changes, those little things that you can do that can make a big difference for you over time, over that year too.
Yeah. I think one of the really impactful things people can do is reviewing their liquidity needs for the year. What that looks like is just taking time to sit down and say, okay, what major expenses do we have coming up this year, right? Do we have to, pay tuition for Johnny's college later in the year? Are we going to have to buy, Susie a car because she turned 16 this year? What do we have on the horizon? We
have a home renovation that we need to do, or a large family trip, or things like that. And I want to skip back just a second and make sure everybody understands what liquidity means.
Yeah.
So for those of you that may not know, liquidity is how easily you can turn an asset into cash. It's going to include the time. It's going to include any fees or anything like that. Is what makes it
or the likely
more or less liquid.
And here's the other thing that people forget about too is the likelihood of changing it to cash immediately without having to discount the asset value.
Yes.
So homes are illiquid because you have to put them on the market, they got to be on the market for 30 days. They got to be under contract for 30 days. You got to pay, 4 to 7% in real estate fees, whatever. It's like, all of a sudden your home takes 60 days and you thought it was worth $1 million. What you end up getting is 900,000. And that's if you don't have to reduce the price to get it sold in the 60 days. So it's an example of something that's very illiquid. Other private investments, right? If you've invested in real estate syndications, it's illiquid. If you invest in interval funds or private placements, right? It's illiquid. But what about some things that I would say are like semi-liquid, right? So you have technically these things I'm going to call out are liquid. You definitely can convert them to cash basically immediately with very little expense, and you don't have to discount them. However, the market may be discounting them for you at the time that you want to convert them. And so in particular, that's going to be like stocks, certain bond funds, potentially like alternative funds. Gold is a huge one. Gold is not exactly liquid. Like today, the price of gold is down almost 1%. That's like, so now you have an asset that you potentially have to time your exit out of the market on that. And there's a ton of risk there. Do it too early, you miss out on a bunch of gain. Do it too late, you might take on a bunch more risk and, not sell as high as you would have hoped. There's a number of ways to navigate that, but be aware. So when we talk about liquidity, what we really tend to mean is savings accounts, CDs that mature at you know what I mean? If you say, well, Susie needs a car in 6 months, we have a 5-month CD or 4-month CD, right? Like that's pretty liquid. It's going to be there and available when, you're going to need it. Money market funds, short-term US treasuries, that sort of stuff, right?
Yep.
And so understand what your liquid needs are going to be and then kind of fill that bucket for the year. Now, you might not fill it all at once, but if you say, oh man, we're actually going to need like $50,000 this year. We have a big year coming up. And you might be able to, but if you kind of identify that now and you say, well, we only have $20,000. So we need $30,000 more liquid this year. You have the ability at that point, because you're not thinking ahead. Well, okay, we better make sure that we, rein in our spending and maybe fill this bucket up from some of our income. And then we might need to visit our investment account and say, let's take down some of the risk. Let's start, let's start kind of taking some chips off the table every month. Like maybe, we feel good about the market. It's going up, all this stuff, but let's at least start taking some chips off the table and kind of filling this bucket up. So that way, when the time comes that we need to dip into it, we're not surprised and flat footed. And the last thing you want to do is, Susie turned 16, you want to buy her the car, and, the market is in a correction. It was down 10% this last month. And so now your $10,000 car now effectively costs it $11,000 or $12,000, right? That's no bueno.
Yeah.
So
and
you want to just plan ahead on that.
You've been talking about for the last 6 months, and Susie's going to be all upset because she can't get it.
yeah. Or you got to tell the kid to wait. And I don't know what it's like to have a daughter that's 16, any kid that's 16 at this point, but, I got a daughter that's not even 1, and it would break my heart to tell her no already. So, all right. I think we could probably do a whole episode on why tax planning is important. Let's table that.
Okay. But I do think that we should just mention it at least.
Yeah. All the stuff that you wish your CPA did for you that they don't do is probably called tax planning. And it's because they tend to either not like doing it or clients tend to not like paying for it.
Yeah.
One of the two is what I found. Super important though. At the beginning of the year, there's not a ton of things that are like super important that you get right from January 1st, right?
Yeah.
Except like if you don't want a bunch of K1s, don't go and make private investments.
Well, right? It goes into your liquidity planning and things too, of like, where am I going to pull those funds from and how is that going to impact my income? And
totally. So I just think that it really deserves a bigger conversation. It is probably one of the more like complex topics that people really do need some professional help typically on tax planning and understanding the tax implications of different decisions. We love sharing those thoughts with people. do a lot of tax planning. I think that conversation becomes a lot more relevant in people's minds as they get their taxes done in February, March, and April. And that's a really good time that when you do an analysis on your tax return for last year, right? So accountants done with your taxes, it's like, take that to your financial advisor and say, here's my tax return from last year. Here's my most recent pay stub. Are we on track for this year? And what can we be doing to enhance my, lifetime tax liability? What should we be doing different? And without going into, an hour of its own depth there, that's tax planning.
Yeah.
Okay. I think the last thing here. Okay. After tax planning, what else is just so important to do?
So another thing that I think is super important to do is to review your estate plan. If you don't have one, then you should create one. But reviewing your estate plan, looking through, making sure that there haven't been any major changes, looking at your beneficiaries and seeing how they are listed on your accounts. If they are, put on there properly on your checking accounts, your house, on your investments, your life insurance, all of those things, so that you can avoid some major issues if anything were to happen. So.
Yeah, I think if I could add something to that too, I'd say knowing where your estate documents are. Yeah. So I think there's a difference between having estate documents and having an estate plan. But knowing where your estate documents are and then having digitized copies, particularly of the LPOA, or sorry, not LPOAs, the POAs.
The power of attorneys.
The power of attorneys, right? So your advanced healthcare directive in particular, and then maybe your durable financial power of attorney, if you have them. If not, I encourage you to get them drafted.
Yep.
One of the things that I always think about is, an advanced healthcare directive is a document you really want, and you want to never have to use it.
Yeah.
Right? It is the worst kind of document to need, basically. But if you need it, when you need it, no one ever thinks to grab it. Yeah. So some people say put a copy in the glove box, do this, do that. I'm a fan of digitizing it. I know that we give our clients access to an app that we have that, they can securely have it, encrypted but have it mobile and on the go. And the whole point of that is if something happens to my wife and, she's off in an ambulance ride, the last thing I'm thinking is got to go get the power of attorney and advanced healthcare directive before I head down to the hospital, right? Yep. It's you're in the car, you're gone, you're down. And then all of a sudden, my wife's her own adult. They don't, they're going to look at me and say, that's really nice that you're married. We can't take your directive. You can't make decisions here. Yeah. We can't give you information, right? But if you have it, you can say, okay, well, hold on. I have a copy on my phone. And that's when you can pull it up, right? And so know where your documents are, and then know what they are, and then know like when you would potentially need them, right? Like what situation. So just have some general understanding about that. And the other thing I'll add is like maybe when it comes to like a trustee or like have a trusted person that you're going to tell where they can find the documents as well. Yeah. You don't have to tell people what's in your documents, right? But if my, sister or something was going to be the trustee, I would probably want to tell her just like, hey, just so you know, like we have an estate plan. And if something happens to us, I just want you to know that estate plan can be found in X location. Yeah. Right? Like it exists. That's where it is. And that will help everyone a ton. Yeah. It's a very unsavory time to go through, and having the little things buttoned up, I think is really, really crucial. But yeah, update beneficiaries on all your stuff. Make sure that's all buttoned up. Like that's part of good wealth management, whether you hire us, whether you do it yourself, whether you have somebody else that's helping you, like the person that's going to look out for you the most is you. Yeah. Right. You're your own biggest fan. Just update your own stuff. Like, make sure it's buttoned up, and move on. The last thing is probably in line with that is reviewing your insurance for the year. Yeah. In case anyone hasn't heard, property and casualty insurance price is going up significantly. Yep. I'm not even going to say significantly. I'm saying for a lot of people drastically. But you have options. So be prepared. Either be prepared and understand that like you're probably going to be paying more this next year. So budget accordingly, or understand that you're going to have to go through a process to maybe shop around a little bit on that.
And understanding what your coverage is, what that means. If you need to ask your, your insurance agent, like, do you have the proper amount of liability coverage and things like that?
Yeah, I did a great episode with a friend of mine, Rustin.
Yeah.
Back earlier this year, where we talked about that, and we went through what they call a deck relations page, which is kind of like a broad overview of your coverage.
Yes.
So it's all the like, what do I have without doing like the fine print?
Yep.
And like we just went through, what does this mean? What does this mean? What does this mean? What does this mean? And I think that's been a great resource for a lot of people.
Absolutely. I would highly recommend if you're listening to this podcast and you haven't listened to that one yet, go grab your declaration pages from your insurance and sit down and listen to that podcast and look through your declaration page while you're listening to it. And you'll walk away with a much better understanding of what you have and maybe what you need or what you don't need.
Yeah.
I'll link that in the description as well. So if anybody is interested in watching that, that'll be in the description as well.
Boom. Thanks, Mallory. Appreciate it. And then the last thing is like your life disability insurance, life or disability insurance, or even long-term care insurance. If you're kind of at that age, right, you're in that sweet spot. I would say, you should be getting pretty serious about long-term care planning, probably like in your early 50s is a great time to really be getting real serious about that. By the time you're in your early to mid 60s, that window starts to close really fast on your ability to potentially leverage anything outside of your own assets for funding a long-term care plan. So you have kind of a window there, but get pretty serious about that if you're in that age group. Life and disability, like just make sure that it's the right amount of coverage. Sometimes I hear people say, well, I got life insurance through work, and it's like $20,000.
Yeah.
My friends, listen, $20,000 might put you in the ground.
Yeah.
That is what we call a final expense policy.
Basic, yep.
1 year's worth of salary, right? That kind of coverage is not going to cut it if you got people that depend on you. If the only person that depends on you is you might not even need life insurance at all. You probably need disability insurance though, so consider that. If you have people that depend on you, there is a calculation that you want to do. Some people call it the human life value. I don't say that to be cold about it, but you are trying, life insurance is trying to monetize the value of your life. So that way you can still make good on the promises that you won't be here to sort of keep. And in essence, that's what it's it's
intended to make the others, your dependents, whole in your absence.
Yeah, yep. So there's a little bit of planning and thought about like, well, so how much and what would we use it for, or maybe what would we need and how would it get used? And then that kind of, back calculates into what you need.
Yeah.
There's a number of different ways to look it up. I don't care how much people have. I care that you feel good about how much you got.
Yep. Right.
And that your, spouse, significant other, kids, whoever the beneficiaries are, have some kind of plan and framework. So it's not just like a bucket of money. Yeah. If you just leave behind a bucket of money, it'll get spent and burned through faster than you could blink. You will be rolling in your grave on how fast that happens. It is really, really sad to watch.
And that can be part of your estate plan as well. If you want to get that specific, and I think that could be a good place to.
I encourage people typically not to get too specific on the document side. That comes with its own set of challenges. However, some great things to do is have a written plan out. So we've tried to help people. Help people with that, where we just say like, okay, hypothetically, so you get a $2 million life insurance check, you're gone. Now what?
Yeah.
And we have a little bit of thing. We have just something written out that just is, okay, this is kind of what is intended for final expense. This is what's kind of intended for kids' education. Like this is what's intended for emergency reserve, or, paying off the home.
Giving each dollar a job,
investing,
essentially. And
and we're going to invest this chunk to generate income, and like just that sort of thing, right? So that way, it's not so up in the air if something does happen. God forbid. My life would be amazing if every single person I knew did not need life insurance this next year.
Yeah.
Right. But the only way to know that is to guarantee somehow that no one's going to die. And I think that is pretty unavoidable.
Yeah.
So it's a viable thing. And most people that know me personally know I'm not a huge insurance guy. That being said, it's still important.
Yeah.
So I carry some myself. I carry some of my wife, and we do go through every year, and I make sure those policies are paid. And when we put our estate plan in a couple years ago in place, we did go up and update the contingent beneficiaries. Mm-hmm. We keep that buttoned up as well. So
awesome.
All right.
Yeah.
Anything else you want to add?
I think that's pretty much it. I think those are some good steps of things for people to go through and review to get themselves on track or make sure that they stay on track for their finances and just overall financial well-being as they head into the new year.
Yeah. Well, if anyone is still listening at this point, which I am going to venture out to say might not be so likely. However, if you are, you might have some interest in working with us. And I just want to give you a quick update that we got some cool new things coming for this next year. Mm-hmm. We've added some really cool capabilities and processes this last year. And we are currently working on solidifying out a number of different opportunities and offerings for people. So whether that means you just need some quick advice and you want to just pay us for some of our time, we're going to be able to accommodate that. So if you're one of those people that just needs a little bit of help, picking the right stuff and allocating your 401k correctly, right? We can help with that at a reasonable, cost to you. If you want just a checkup on your financial plan, right? We can help you with that. If you don't have a lot of assets to invest yet, but you're looking to get something going, we're going to be able to help accommodate that. And we've added a bunch of really cool tools. So not only do we have the institutional style kind of investment offerings that make us unique, and that's been kind of a fundamental thing for us for many years now, a very unique approach on investing and risk and returns and all that kind of stuff. We've also added the capabilities of helping people with estate plans and getting those documents put in place. Mm-hmm. We've put in the capabilities for tax planning and analysis there, which is really cool, integrates really well with the investment plan. We've got some cool tools for income planning and understanding kind of what you need to be doing to get on target. We've got some great partnerships in place for the insurance pieces as well. So, we continue to round everything out and are here to, serve people. And if you think you might need our help, go ahead and reach out. We're happy to have a conversation when you're ready. We certainly, if you know me, it's like a no pressure game. In fact, I think I probably don't, I do like the opposite of pressure. I kind of shy people away more than anything nowadays. But we're happy to do some engagement and see what we need to do to help you out and see if it's a good fit for everyone involved. If it's not a good fit, we're still going to
give you some value for,
we still try to help people out and get them going in the right direction at least. Mm-hmm. So, we big believers in karma down here. So anyways, that being said, thanks for following along. If there's anything we haven't talked about on the podcast, and you are now definitely our most dedicated listener, send us a message. Let us know what you want us to talk about. Let us know what questions you have. We're happy to do an episode on anything that you think is important or meaningful or impactful to you. We're pretty well diverse. I certainly have a lot of books. And if it's not something that I feel really confident on, we'll go research it on your behalf and see what kind of information we can push out there for you. So that being said, let's call it a wrap. Happy New Year, everyone.
Happy New Year.